So one of the robustness tests that you can do to find if your strategy is going to perform well in the future, because that's what robustness test is you build a strategy. Of course, it's profitable because we have SQX. Couple of seconds, you have profitable strategy, and you want to now see if this strategy makes sense or will it perform in the future. If you're making $1,000 a year, will this strategy makes, I don't know, $800 a year? So that's robustness testing in a nutshell. And one of the robustness testing we have here is system parameter permutation and work forward analysis, or matrix. So the matrix is just a bunch of these. And these are the main ones. I don't use these. I mean, you can use them to filter. We have mentioned this many times before. But mainly, this is the best we have right now. So to do the... first, let me explain to you, just in case you don't know, what is walk forward optimization. So let me get the pen here. Imagine you have a bunch of data. So if you divide the data, let's say, for example, most popular is 80-20. So this is data, let's say, I don't know, let's say this is 5 years. So you split 80 and 20. On the in sample, you pick the best parameters. So let's say you're trading, actually I'm going to do the same system. So you see this system. So this is a trend following system. It goes long when the EMA is going up, so higher than the EMA before. This is the short EMA, 20, while the SMA is going up, and this is 80. So really simple trend following. We know trend following works. Like, I mean, I know this is a robust strategy, okay, ahead of time, but we will find out. So what I only have two parameters, yes, EMA and SMA, but these can be 4 variables. Like EMA 20 could be greater than EMA 30 1 bar ago, okay? But let's assume it's only one. So if you put 30 here, this will be 30. And if you put 100 here, this will be 100. So basically we have 2 of them. And here the parameter will change. So SQX will find out, okay, what's the best parameter? Let's say it is 87 here. This is SMA. And EMA is, let's say, 22. So it will take these here, if I can draw, and it will test EMA 22, SMA 87, and it will have a performance here out of sample. Then it will shift this by the same amount. So roughly, let's say it's here. And now this is the 20%. This is 80%. It will do the same exercise. And let's say here, EMA is, let's say, 19. And SMA is 100. It will take these figures, test this one, and so on and so forth. It will keep doing this as many times as you like. So this is run 1, this is run 2, and it can be up to you. Once it's done, let's say we did 10 runs, it will combine these out of samples together, and these, they will form whatever your curve is. And so why this is an indication of robustness because I'm always testing the out of sample. Like I don't know the out of sample. I'm testing here, trading the out of sample. Testing here, trading the out of sample. So theoretically, I'm always trading future data that I haven't seen. And so this is considered robust. Now, walk forward analysis, of course, it's better than nothing, but it does has its caveats and it's not perfect. And if you feed it garbage in, you will get garbage out. Same story with everything. There are like, let's say, guidelines of what is a good walk forward analysis. So to test this in SQX, like I said, I built the system. And by the way, if you're questioning how this system is exiting, there is a ATR, 4% ATR exit. Also, you can make it easy if you want to do the test yourself. You can exit with the same SMA. So SMA 80, lower than SMA, 81 bar ago. And we can switch this off. And this looks worse, but in reality it's better. This one has a better drawdown. In any case, so you save this, bring it to the retester. Here they are. Version 1 is with the SMA, version 2 with the ATR. And I can show you. So this is version 1. And you can see the open drawdown while we are holding a position, because we're holding on average for 50 days. So it matters what's the open drawdown. 36. The one with the ATR, the open drawdown is 51. But it looks better on the chart because the open drawdown doesn't show on the chart. So this looks ugly. I mean, little bit. This looks better. But anyways. So let's bring this one and I will apply, and we will go full settings. So we're trading the S&P 500, the SPYs. I have data since 93. And let's say commission is 5. And we are using stock size by price. So that means I'm investing all the account all the time. And no cross check. So this is the test, because these are the strategies. I did the test already. We have it. So now let's do the so let's bring this again, apply, and data, let's do 5, money management. Okay, now let's do the cross check. So I will use walk forward analysis. And let's try to understand this. So the slower version, it's more accurate. And then the percent and days floating and fixed. So remember this graph, I said 80 and 20. And this is the out of sample. So 20 means I have 80 in sample, 20 out of sample. Of course, you can change this to any number you like. And then these runs, number of runs, is this guy. Okay? Now, my system, which is this one, has what variables? The look back period. That's the only variable it has, this one. The other one has the ATR variable. So this one has only the look back period. So we're telling SQX here that change my look back period by 25% up, 25% down with a maximum of 20. So that means I go, for example, on my 20 period, I will do 20 times 1.2. So that's 24. So I will go from 20 to 24 at how many steps? Maximum 20. But how many steps I'm allowed here? Most likely 2. I don't know if StrategyQuant X takes like 21.5 as a moving average entry. So that's what we are asking SQX to do. Now, this is recommended. You can pick your own settings, for example, periods or shifts. Remember, I have a shift also where the moving average is greater than the previous moving average. I can shift that by more than one. Anyway, you can pick your own or pick the automatic. Let's stay simple now. And then depending on this combination and this combination, you will have number of tests. You can limit that number of tests. So this is the maximum allowable test. This does not mean that we will have 5,000 tests. If these variables times these variables will give me a number. Okay, so let's make this 10 now, and let's make this 30, which I think the defaults if you switch it on. And from these tests, now you can do some filtering, comparing this out of sample to this in sample. So you can say, well, if my in sample had, I don't know, $1,000 profit, I want my out of sample to have $200 of profits, because this is 20% of this. So you should look at least for the same profits. Or of course you can make it annualized, and you say, well, if this is 10% annualized, I want this also to be 10% annualized. Once you put the filter on here, you can switch them on. It will do the same test anyway. It will just tell you if the test fails or succeeded. So all these filters will not affect the test that's going to happen here. It would only tell you if it fails or succeeded. So let's do that without any filter. I'm going to save. Now I will go to, I think we're doing this one. So I'm going to put it in the Discord session, and let's test. So this is the test, and I can see walk forward. And if the filters were on, then that's it. It will either tell you here passed or failed. And it will tell you which filter has failed. So I'm trying to say that all filters will work anyway, except if you switch them on, it will say pass or fail, which helps you in filtering many strategies. Since we're doing only this one, this doesn't matter. And let's try to understand this part here. So now that I told SQX that I want 20% out of sample and 10 runs, so it has to divide whatever data that I picked, which is here, into 10. Okay, so I have data from 93 till 21, so I divided that by 10, and it reaches this number, 3,491 days in sample, 699 out of sample. These figures came from the number of runs. This is not arbitrary, and they are important in 1 second because I'm going to show you why. In any case, you divide this, so your in sample then starts from whatever the start of the data plus 3,491 days. We come to 2002, and then this is the out of sample. And in this in sample out of sample, this is the net profit of in sample, net profit of out of sample. The green ones are out of sample, so it's easy to find out. And this is the drawdown. And remember when I told you that then you stick these out of sample together and you get one curve. So that is, if you go to equity chart and you pick out of sample for the 10 runs, now this is my curve, my strategy. It's stitching all these 10 runs together. So this is my original strategy, the gray one. And the green one, which is this one, is my new strategy. Okay, so the out of sample is still profitable, but is not the same as the in sample. Okay. So coming back here, if you want to make this constant, meaning I don't want this to be here, I don't know, 3491, that's, let's see. So that's 9.5 years. So this is 9.5 years, but if my data starts from 2008, of course, this will not be 9.5 years. So in that case, when you test many strategies on different data, you need to make this comparable to others. Yes, you need to compare apple to apples. So you cannot let StrategyQuant decide this value. This one. This one cannot be percent. I mean, it can, but I'm just saying you're going to be building a workflow. Your workflow should be consistent. So when you're comparing, it's easy. So you need then to fix it in number of days. So you can see this is percent, and when days, it just says the number of days. So in number of days, I can say, look, I always want to test 5 years as in sample and 1 year as out of sample. So 5 years times 365, that's 1825. And 1 year is 365. So now, whatever you throw at this, if it's S&P 500, if it's Euro USD, if it's, I don't know, Tesla, which has only 7 years of data, it will always put the in sample as 5 years and the out of sample as 1 year. So it's always not percentage now. This always will be 5 years and this is 1 year. And now when I do this, of course, I just increase now my number of tests because...
Sorry?
Yes, Chris?
Why 365? I mean, there's no 365 days trading
Yeah,
days.
but this uses calendar days.
Yeah, but this uses calendar.
Okay.
Yeah. So, so now let's do this one, and let me progress. And you can see now we have more tests because I fixed the number by days. So now the number of runs depends on what I picked as in sample or out of sample. It's not fixed now as 10. And then you get the same thing. So if I go to equity chart and I pick this one, and you see now these sections are my out of sample, and now this is my strategy. Now, if you want to find out what's the parameters, of course, it's written here. So you can see this period is picked. Remember, my strategy was 20 for the EMA and 80 for the SMA. So for example, this one is 14 and 66, 1481, 2461, 1461. Now, why this is important? Because there is actually a measurement you can measure how stable is this changes. So for example, we are like you can see here 14 is comes up a lot. So 14 is a stable number. Anyway, there are measurements. It's not in SQX, so I'm not going to get into it, but it is important to see. And then it also gives you the next step. So for example, here, starting from 19th of October, which is today, if you want to trade this strategy, then your parameter is this. The EMA is 16, the SMA is 61. And you're going to keep trading this strategy using these parameters until October 19, 22. So that's how you will trade this strategy. Of course, you don't have to do this. You can only do the test, find if it's robust, and keep trading the original strategy figures, whatever the numbers are. So in my case, I can go here and keep trading this strategy, even though now I'm getting these numbers. So this will depends who you talk to. You know, some people swear by this. I don't do this because it's not conclusive that these figures will have a better performance than the original strategy. So if you like do this on 10,000 strategies, you will find you're either the same or worse. Of course, if you talk to Bob Pardo, then he will not agree with me. But this is from a hedge fund research that I saw, and so I just picked it up. So it's still a test for robustness, but you don't have to use this. Now, when this will make a huge difference, and Bob Pardo agrees with this statement, is when you're trading a really short-term strategy. So, which is not doable for retail, and that's why I say don't trade these parameters. So in hedge funds, because everything is automated, they have programmers, blah, blah, blah. They do this every day. Okay, they have short-term strategies where they optimize a week and they trade a day. Okay, they optimized last week. So tomorrow's after tomorrow's Monday. They optimized last week. They found these parameters and they trade Monday with it. Then on Monday, they again do the in sample of 5 days. They trade Tuesday with it. Then the parameters makes a big difference. Okay? But practically for you to do it as a retail trader, it's not practical. I mean, I'm not saying it's impossible. I'm saying not practical. And if you're doing more than one strategy, which I always advocate to do that, then it is an impossible mission. Yes, imagine you're doing 10 strategies. You have to optimize all of them, plug in those numbers again, or you have to program all that in. So, of course, that's what they do. It's everything is automated, and you know. But then it's a job. Yes, it's a full-time job. And anyway, now what is okay? So I found this with these filters here. I can do my set and find out if this was robust or not, because when you switch them, you see some of them are red, some of them are wrong. As I told you, it doesn't matter if you switch them on or off. The same test will happen anyway, and the same measurement will happen anyway. But when you switch them on, it will give you this result, Boolean, failed or passed, depending on the percentage. So green pass, red fail. Okay. And by the way, so this is the score. So if I say here, let's see how many we have. So if I say here 10, you see I'm passed because it's a percentage of these. So 1, 2, 3, 4, 5, 6, 7, 8, 9. So I have 4 of them pass, so 10 will pass, 20 will pass also. And 35, I think 45 will fail, yes. So 45 fail. So let's go back to the settings. So hopefully now this is clear. Now why this is, I always say do WFM, don't do this. Excuse me. What walk forward matrix will do is once we run this, so right now I have, let's say 10 runs. I have only one thing is fixed, which is the in sample 80%, the out of sample is 20%. So what if you want to change the in sample and out of sample? So then this is what will happen. So let's zoom out a little bit. So this will be walk forward matrix 1. And then walk forward matrix 2 now will have different in sample out of sample percentage. So now this will be 25%, 75%, and then we will do the same thing. We will test on in sample EMA, SMA, and here maybe the EMA will be 24. SMA will be 95. We will use those figures to trade the out of sample. I will get some figures here. I will do this again. 25, 75, and we will have a different out of sample. And then this is run 1, run 2, blah blah blah, run 10. Now this is walk forward matrix 1, walk forward matrix 2, and so on. So how do you decide how many of these? So remember now I'm changing, I have these fixed, changing the parameters inside. Step 2, I fix these on a different level and parameters test again. And in SQX, this is walk forward matrix. And this is what you can do now, is you can change this percent. So instead of 20, here I go 18 to 22, step 2. So that's 18, 20, 22. So that's 3 steps here. Runs 8 to 12, step 2. So that's again 3 steps here. So 3 times 3, this is a matrix of 9. And if I fix this like the walk forward optimization we did, this again, it only determines the number, the maximum number of, this is not the actual number of tests. This will only based on this variable and this variable, it will decide how many tests and it will limit the maximum. Again, you can do your own or recommended, and again, you can do the filters or recommended. So let's try this one. We should now have a matrix of 9.
Question, number of tests is based on what? Let's say I put 50. What does it mean?
This?
Yes.
Yes. What happens if I limit to a little number, like I don't want to be like super
so
abuse of
you're reducing the
machinery,
resolution.
and I want to put just 50.
So if this is, let's say, this combination, 3 times 3 is 9, and then step 10 up and down, that's 20. So let's say that's 180 tests. If you put 100 here, it will skip 80 tests. So the resolution is lower.
The resolution is lower.
So I just did the test. And this is the matrix. Chris, I muted you because I can hear echo. So you can unmute yourself, correct, when you want to speak? If not, just type it down in the question and answers. Okay, so this is the matrix. All of them passed, of course, because I have nothing. But again, it's the same story. Like if you put the filters, it will do the same test. This passed, fail, it only based on this version now. You can say, well, in those 3 by 3, I want 7 of them have a score of 50, and then it will tell you fail or pass. But regardless of those filters you pick here, regardless of this filter, the same test will be done. So now what do we have here? So now this is run 8 and 18, and this is run 8 and 20, 8 and 22, and so on and so forth. And we can see now a surface. So for example, all of them are profitable. And this is the worst one. Run 8 runs and 20% out of sample. And same story here. So this is the parameters for excuse me, for 8 runs and 18% out of sample. And let's see. This is now 8 runs and 20% out of sample, and we have these parameters, and so on and so forth. And then if we go to the equity chart, same thing. If I pick this one, then this is the stitched out of sample, and you will see each one has its own curve, because each one is a separate walk forward optimization. Same thing with trade analysis. Each one will have its own figures. Now to understand this, so 3 by 3, that means I'm picking the whole 9. Why? Because my matrix could be 50. I picked 9, so it's easier. But your matrix is always the result of these variables. So you multiply how many steps here by how many steps here, not this number, but when you step at 2, how many variables you will get. This is the matrix. So this could be any number. If I put this to 1, so now 18, 19, 20, 21, 22, that's 5 times 3, that's 15. So if I do this test now, my matrix will be 15. And you can see now I can still pick a matrix by any number I like. So when I say this, I'm saying any 2 rows and 3 columns can be a matrix on its own. So for example, let's say 2 by 2. So this square is one matrix, and then this square is one matrix, and then this square is one matrix, this square, this one, and you can see there are many combinations. But if I say 3 by 3, then the only combinations I have, this is 1, this is 2, and this is 3. So when I do matrix of 3 by 3, I have only 3 available to me. But when I do 3 by 2, let's say 3 by 2, so this is 1, 2, 3, and 4. So now I have 4 of them. In any case, what does that mean? When I say 3 by 3, I have only 3 of them, and I'm saying, look, in any 3 by 3, when 7 results, because I have 9, and of course I can change this. So I have 9, and let's say I want half of them. Half of them is 4.5. So let me pick 5. So in any 9, if 5 of them have a score of whatever I pick, and now this score is, actually we should have put some, let's repeat this and put some filters. Okay, so I'm saying now, let's go back 5, 3 by 3. And let me get rid of this. Okay, so this looks good. So now, remember, filters don't affect anything. They are just calculated anyway, and the same test will be calculated anyway. So don't be afraid to add any filter you like, and then you can always switch it off and see the effect on the matrix. So for example, if I pick, let's say 9. So here, what did I say? I say in any 3 by 3 matrix, so any 9, I want all of them to have 80% success score, which is this one. So since now I have this one, so obviously that means I failed. If I put this to 8, it will pass, yes, because it doesn't matter. In this square, I have 8. In this square, I have 8. In this square, I have 8. In all of them, I have 8. If I do this one, it's the same one. So this is my workflow based on what you teach. Generate daily strategies distributed out of sample according character market. Test additional correlated market, double spread and slippage. Lower and higher, time frame, Monte Carlo, exact history, robust test, last out of sample in the end part, market regime, good for workflow. Yes, it's good for workflow for anything. So I would say for any instrument, and just to make sure that this is the hold out period. And I wouldn't worry about this. In the beginning, daily strategies are more stable anyway. So correlation only will mean that you don't want to trade highly correlated strategies. But I wouldn't say that the market has to pass a correlated, the strategy has to pass a correlated market in order to be robust. When it's long term, then it should work on correlated markets. When it's short term, then it should, it could, but I wouldn't put that as a condition. And what's short term? This is not, short term is not intraday. Short term is daily. When you're swing trading, remember why this one worked on the S&P. Like if I put back here the S&P is not a trending market. But why this work, you need to understand the concept behind it. What you are picking is, if this is the long trend, it could be very noisy, and you are picking these parts in this strategy. You are picking the swing highs, okay? That's what the EMA 20 picks up, and when the SMA, this is the SMA, this is the EMA. So you're picking up again the trend, but you're picking up only the swings. So in this case, I don't expect this to work on other markets. It doesn't have to be if this swing, it's like 4 days. Because this could be 4 days here, it could be 8 days in the Dow, it could be 20 days in Amazon. So no need to be correlated. But when you say 80 days, then it should be, I would expect to be performing the same in correlated markets. And let's see. Should I test Forex in demo? Always, because there might be something wrong in the code, or so it doesn't hurt to always try demo first. But demo now is not about robustness. Your robustness test is done here. Once you pass SPP or WFM, you test. Maybe we can put this again here. So you test, then you take it. This is in sample, out of sample. Then you take it to WFM or SPP. Then you take it to hold out period. Once you pass this, now when you go to demo, it's not robustness now. Now I just want to make sure that the code is correct, slippage is correct. That's it. Although slippage you cannot find in demo anyway. If you are in Forex, I would much better prefer to trade micro than demo, because micro will give you an idea about slippage much better than anything else, and it also tests the logic, and the worst you can lose is like, I don't know, $30, $50. So it is more difficult in futures and stocks because you cannot do the micro.
Okay, the question is, how do you know what type of logic testing in a market? Let's say I want to develop strategies in coffee. So I don't know if I took mean reversion approach or trend following approach, or maybe it goes from one logic to another in that commodity. How do you know what type of logic to apply, or if this logic is switching from certain periods on the year?
All you should try, of course, if you just came to trading, you know nothing, of course you should try all strategies on all instruments. The fact is, the robustness testing will fail the instruments that doesn't work. So if you come from that point of view, then you should try everything. The only thing is, we want to make things easier on ourselves, then that's why you need to trade the character of the market, because then it will be easier to find robust strategies on that instrument. So it's not a requirement. The S&P 500 is a mean reverting instrument. It's not a requirement that you need to know this information to find strategies. But it will take me 5 minutes to build a mean reversion strategy on S&P 500. And if you want to try trend following, it will take you, let's say, an hour or 2 days to find robust strategies on the S&P 500. So from that point of view, okay, it's not necessarily, but it is beneficial, very beneficial, to know the character of the market. To know the character of the market, there are many ways to measure noise. So of course, you are all familiar with Perry Kaufman, and so it depends on who you talk to. There are different ways to do it. I have my own way to do it, which is in the course, but basically what I'm doing is I am measuring the noise. So if this is a curve, and let's say this is a curve, obviously both of them are trending up. The black one is very noisy. And the red one is very trendy. So if I want to build strategies, the trendy one will have an easier time. You will have an easier time to build trend following strategies on the trendy market, or breakout strategies. Remember, breakouts are just strategies picking these swings. But mean reversion strategy will fail on the trendy market, but will make a lot of good money on the noisy market. Even when you take the opposite trade, like here. So this side and this side. And it will be very difficult to build trending strategies on the black line. You will only succeed if the trend is too long. So for example, 150 days. So 150 days will catch any trend. But even then, if the market is noisy, this will not be profitable. Especially like, for example, agriculture products. Because they don't trend, they don't go up forever like energy and agriculture futures. Like the stock market can go for up forever. So even 150 days will work. So how to find out? Like I mentioned, many ways. I will teach you one way, which is my way. Remember, this is the same concept like my market regime volatility. I don't have like something out of space that I, was dreaming about and did. This is something that, it's like my own flavor of, I don't know, whatever your favorite food is. So each one cook steak differently. Still, it's all steak. But, somebody might have prime meat, somebody might have chicken meat, and somebody might have black and pepper, and so on and so forth. So this is my flavor. Of course, my flavor is excellent because it's mine, yes? I developed it. I been through it many times, through many years, through many markets, and that's why it's worked for me. And it is based on something solid, like this. So I just gave you now. Trend following works. We know it works. There are at least 400 white papers written on it on SSRN. AQR hedge fund did a research that shows it works since 1200. Now, trend following, I don't need to test robustness for trend following anymore. I know it works. Now, what's my flavor of trend following? I don't want to trade holding 50 days. Okay, or I don't want to trade with 15% drawdown. I need to cook my flavor of trend following that works for me. And so the way I found which market is noisy and which one is not is my flavor. But like I mentioned, you can, like Kaufman efficiency ratio, that's one measure. There is something called in statistics co-integration. It's a little bit, mathy, but for some of you probably it will be good. There are many ways to find out. But like, again, back to square one, it's not a necessity. It will only make life easier for you to develop strategies. But even if you start from scratch, it is okay. Okay, LT, 3x3 matrix, kind of standard, 7 out of 9 and 80%. And 80%, I guess B, it's easier to pass. So this, again, remember, I'm teaching you here concepts. I don't want to give you, here's what I do, go copy it. Because like I mentioned, at the end, you want to build your own flavor. I'm going to teach you what I do, but hopefully you will start with it because obviously you're coming, let's say, with less information or zero information, or maybe better information. I don't know. But the idea is to take mine, understand it, and either use it the same, doesn't matter, it's okay, or build your own flavor to go with it. And same applies here. So 3x3, 4x4, 7x7, 10x10, it's all increasing the resolution but compromising the time. So more resolution is better, but how much more? Okay, if I show you this screen now, you're seeing is HD, so 1920 by 1080 pixels. If I throw in 4K image at this screen, there is no difference because the maximum resolution it shows 1920 by 1080. And let's say this is a 4K screen. How much difference will you see if I put the two pictures on, like HD or 4K? Is that difference material? Will it make a difference? So these are not fixed in stone answers. Like I cannot say, look, 7x7 matrix is the best. I know it's more resolution. It's definitely going to give you more data, but how long term? If it's going to add 10 hours to your workflow, how material is that to your end goal, which is trading profitable portfolio? I would say in the beginning, it does affect you, because in the beginning you want to trade profitable portfolio quickly. But let's say once you have two portfolios working for you, you have 100,000 invested, it's going to be a while till you come up with more money to trade another portfolio. Okay, I will increase the resolution. Because remember, you need to find out your boundaries. So to me, let's say 6x6 is good. To you, it might be not good, or somebody else, it might be overkill. So, but if you don't understand how this thing works, you'll just copy me blindly. And that's why all my videos about the technical indicators, I explain how the indicator works, not because you will go and program it, because, you know, all the indicators are available anyway, built in. I just want you to understand how the indicator works so you know what boundaries to give it, what look back period, what multiplier of ATR. Because, like, don't go just blindly and do it. And that will affect, of course, more experience. You will know how each parameter works. And then when you go here, then you will put your own parameters, because now you understand. So this will not be percent or 30%. No, I will go here and I'll pick my own periods, blah, 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 because now you understand. Of course, SQX has this built in, but the problem it's general. So let's say you pick, I don't know, ADX. So you can see there are already multiple sets based on something practical. But because SQX trades future currencies, crypto, forex, this might not be ideal. And that's why they give you the option to build your own sets. So you will build your own sets that make sense in crypto, another set that makes sense in futures, and so on and so forth. But you will only be able to do that once you understand how the indicator works. Of course, that's a long process. You don't have to do it from the start. I'm just saying. So back to your question. Yes, it is the same concept. You're always looking for 80%, but the bigger it is, the more resolution. And of course, 2x2, it's a very rough idea matrix, and 9x9, 3x3 is much better. 4x4, I would say it's even better, and it's practical. More than 4x4, then it's up to you. Depends on your computer and how fast and so on. Monte Carlo resampling or exact. It looks some good strategies cannot pass resampling, but definite portfolio can pass it. Perfect. Again, if you understand what you're doing, that's totally fine. I don't use Monte Carlo as a robustness test, so it doesn't matter to me. But you need to understand what these are, and if you don't, we can discuss it now. So resampling is exact is taking the whole. So if you have 100 data points, then exact, of course, it will take, with full sample, it will take the 100 data points, reshuffle them, blah, blah, blah. With resampling, you're repeating some trades with the hope of, if you have an outlier, it will be repeated. So let's say you have a strategy. Let's say you have this distribution. So these are your trades, and you have one outlier here. If you do this exact, you will always have one outlier. If you do resampling, this could be go to 1, 2, 3, 4, 5, whatever. Yes, of course, this will, because it's an outlier, it will affect the profile of the strategy a lot. So when you resample, this will shows up. And of course, it's the same on the other side. So if one big loss you have here, when you resample, this will show up more, theoretically. I mean, it depends on how many runs you're going to do. The more runs you do, the more this will show up. So once you understand this, then you can decide if you want to use resampling or exact. Of course, if you don't use this as a robustness filter, then this doesn't matter, because those outlier will show up in SPP anyway. Yes, so LT ask if it's better to use 4x4. I would say yes. If it doesn't bother you, a good computer, I would do 4x4. It's more resolution, like I said. But let's say 10 is overkill. Yes, 10 by 10. 4x4, 5x5 is even better. 6x6, I would say, is the maximum. So let's put it here between 3x3 to 6x6. Anything there is good. So WFM could be the only robustness test. It is the one I use with SPP, either one. I used to use WFM. When SPP launched, I'm using SPP. They both do the same thing. So not the same thing exactly. They both trying to do the same thing, I should say. And you can see they're changing the parameters. So Monte Carlo doesn't change these parameters. Monte Carlo has one thing to work with, which is the PNL. So PNL is the only deciding factor in how Monte Carlo will work. So if your strategy is overfit but has good PNL that can withhold noise, then Monte Carlo will succeed. And I did the test. Check the video of the walk forward, the Monte Carlo on the Discord. On the Patreon page. So, but the advantage of WFM and SPP, they both change parameters. So that's good. You need to pick one or the other. I wouldn't do both. So you're saying SPP is faster than WFM. It doesn't matter. I mean, the speed is not going to be double the other one. It's going to be very close. So pick with one and stick with one. Because remember, you need to be consistent. So if you like WFM, that's it. Stick with WFM. WFM or SPP, they both achieve the same goal, but they don't have to be matching all the time. Like I've seen some comments where you run something on WFM and it fails on SPP. That's overkill, really. One of them is more than enough. All your strategies will fail in the future. So you don't want something that is written in stone. That's it, this is successful. No, all strategies will fail. So you just need to have a consistent workflow. So find one that works for you and then just start using it. And until something better comes along. But to do all of them, it's overkill. Should you run WFM or SPP only on the build range, start date? Yes. Obviously, the holdout period has nothing to do with this. This is the workflow. Test in sample out of sample on the data available, and then you have a holdout period that you don't test on. Here is the test for the holdout period. So test in sample out of sample, WFM SPP. Once it passes, then you test on the holdout period. If it passes, that's it. If it fails, also that's it. You don't trade it anymore. So let's say we have, today data. So let's say You leave last 3 years, so 2018, 2018 till 2021. Okay, that's the holdout period. Then in sample, out of sample here, doesn't matter how many times, whatever. You can split this again, you can do this, you can do in sample, out of sample, then do WFM with this data. This is creativity now, it's up to you. But either way, you don't touch holdout periods. Just remember, when you're watching the equity curve, you need the out of sample and when you're doing walk forward, because that's the one that's important. It's this part, yes, you want to this part stitched together. So don't look at the in sample, because the in sample, it's optimized. You're picking the best strategy that made money in that period. So just keep that in mind. Always look at the out of sample. Generate strategy with purpose and methodology, not randomly. Can you explain? If you are new trader, you need to know what works and what's not. So I just established mean reversion works on mean reversion strategies, really easy. Trend following works on trend following instruments, really easy. That's on purpose, yes? If today I want to build a profitable strategy, I will start with ES, RSI. Definitely I will find a robust strategy. Okay? Of course, with the all information available to us today, and even with my YouTube channel, you can rest assured that mean reversion is a robust strategy on ES. Trend following is a robust strategy on interest rate. You don't need even to bother with doing robustness testing if you follow the guidelines, yes? Now, what if I want to trade intraday? Well, I don't know in that case if my strategy is robust or not, because now I'm very close to the noise, yes? The noise, each instrument has its own noise. So if I'm trading intraday, and I don't know, this is what the strategy is doing. So yes, we started here, we ended here, but then this area, that's noise. If I trade this daily, so this could be like this daily. Okay, let's say the next day started here. If I trade daily, so I will enter here and I will exit here. No noise, easily. This is assuming this is green, yes? So I trade close greater than the open and I'm doing well. Intraday, I see a lot of noise. Of course, I'm saying intraday because noise is available on all time frame, depends on the instrument. I'm just trying to make it clear. So you want, if your strategy, if your instrument is noisy, then trend following will lose, because how are you going to hold through this part? This is extremely difficult to hold through if you're going long. So then you need a different strategy to capture this part, or your trend following has to have stop loss here. So between here and here, let's say that's 5 ATRs. That's a lot, yes? That's a big stop loss. So in that case, I need to find some other way to build. And that is what we call the data mining, yes? So data mining brings all these blocks. And of course, you can have your own blocks added to this, which, like, for example, I have many, yes? I build and I keep adding to them, because then, data mining will stick 2 or 3 together, and we try to find out, because I don't know what works, what's not. On purpose, it's when you know what's working, what's not. So I know RSI on daily time frame on S&P works, so then I will use that. And this is what's on purpose and randomly. Now, even with randomly, you're not just randomly. So for example, here, if you go builder and you see there are already templates. So mean reversal, what's this? What's this doing? You know, this is a template picking the things that works with mean reversion. So you can see here building blocks. These indicators works with mean reversion strategies. Awesome oscillator, lower and upper Bollinger Bands. So for example, CCI is not picked because CCI does not work well with mean reversion. DI, this is a component of ADX. Again, it doesn't work well. This works well in trend following. So for example, if I pick trend following, this should be in. See, it already picked DI. Why? Of course, because I know, but I just told you. And of course, you will know this. You know, you'll start testing, start trying, understand how indicator works, and you will know, oh, this indicator should work on trend following. And this indicator shouldn't work because it's doing this. And that's the idea. So even this, it's not random. You're actually, like, you don't want to do this. You don't want to, you don't want to do this. You don't want to do this. Click all and click all and find out what works. That's most likely you'll get an overfit strategy. So you know, you want to be, even in randomness, you want to be purposeful. LT is WFM SPP included as kind of a bonus. You mean in SQX? It's definitely not. Oh, okay, I understand. So he's asking, when you do SPP, you will get walk forward profile because they're both doing this, changing the parameters. But SPP calculates the median, compares everything to the median. WFM does it in a different way. Yeah, I know it's there because you have to. You're gonna build a profile anyway. Just understand this. Both of them are changing the parameters, and so both of them, they will have a profile. So it's not a bonus. It is both of them building the profile, but they are testing it in different way. So the only reason I want SPP more, even though it's handicapped in SQX implementation, but it bases everything on the median, and median is much better representation of your future expectation. I would much rather have the median, because then, like I told you here a while ago, SPP will take care of the outlier, because here the average will be somewhere here and the median will be here. So the median will not be skewed by outliers, but the average will be. And so that's why I like SPP. But both of them, yes, are building the same profile, but their filters are calculated based on SPP, calculated based on median. And that's why I said don't do both. So at least, okay, now you came to the conclusion that, oh, both of them are trying to do the same thing. So don't use both, just use one of them.